As the markets closed on Friday, September 12, 2025, Connexa Sports Technologies Inc., trading under the ticker symbol YYAI, finished the session at $2.28, marking a gain of 9.09% for the day. This recent upward momentum concludes a week of volatile trading for a company that many investors have mentally cataloged as a niche player in the sports technology sector. However, the prevailing expectation that Connexa is simply a story about tennis ball launchers and athletic training aids is a dramatic oversimplification of a far more complex and turbulent reality. What most of the market is failing to price in is the company's aggressive and somewhat bewildering pivot into the cryptocurrency and artificial intelligence matchmaking spaces, a strategic shift that introduces an entirely new dimension of potential and peril that goes far beyond the tennis court. The common ground is the belief that Connexa is a small-cap sports tech firm trying to innovate its way to profitability. The reality, however, is a company undergoing a radical transformation, venturing into highly speculative sectors that could either catapult its valuation to unforeseen heights or lead to a spectacular collapse, leaving unsuspecting investors in its wake. This isn't just a story about sports equipment anymore. It's a high-stakes gamble on the convergence of disparate, cutting-edge technologies. The recent daily swings in Connexa stock price paint a picture of a classic battleground stock, one that many retail traders on platforms like Robinhood and SoFi Invest are likely watching with keen interest. The stock has experienced extreme volatility, with a 52-week range stretching from a desperate low of 35 cents to a dizzying high of over $10. The trading volume tells its own story of speculation and uncertainty. While the last session saw a volume of around 282,000 shares, its average volume over the past 3 months is significantly higher at 1.6 million. This discrepancy suggests that while the stock has its moments of intense speculative interest, it can also go through periods of relative quiet, leaving traders who bought at the peak of a frenzy in a precarious position. When you compare this to the colossal daily volumes of market titans like Tesla stock or Apple stock, it underscores the microcap nature of Connexa and the inherent risks associated with such thinly traded securities. Institutional activity in a stock like this is often minimal, meaning its price is more susceptible to the whims of retail sentiment and momentum chasing, a factor that any prospective investor using a platform like Fidelity or Interactive Brokers must carefully consider. The recent price action appears to be largely news-driven, particularly by announcements that have very little to do with its legacy sports technology business. This creates a significant challenge for traditional valuation models, as the company's future is no longer tethered to the predictable revenue streams of sporting goods, but to the far more unpredictable world of digital assets and AI-driven services. At its core, Connexa Sports Technologies began with a focus on creating innovative products for the sports market. Its flagship product, the Slinger Bag, was a portable and affordable tennis ball launcher that aimed to democratize access to high-quality training. The company expanded its portfolio to include PlaySight Interactive, a leader in AI-based video and analytics technology for a variety of sports. The business model was straightforward: sell hardware like the Slinger Bag and offer subscription-based services through platforms like PlaySight to clubs, coaches, and individual athletes. This was a tangible, understandable business targeting a clear demographic. However, the company's financial performance has been a mixed bag. While it has shown impressive revenue growth at times, profitability has remained elusive, a common struggle for hardware-focused startups that face significant manufacturing and marketing costs. This pressure to find new, high-margin revenue streams is likely what prompted the company's recent dramatic strategic shifts. A look at the company's financials reveals a history of operating losses and a reliance on capital raises to fund its operations, a situation that has led to significant shareholder dilution over time. For those considering a long-term investment through a vehicle like Schwab Intelligent Portfolios, this history of unprofitability and strategic pivots should be a major point of due diligence. It's crucial to look past the surface-level narrative of a sports innovation company and delve into the numbers that reveal a more challenging operational history. The future outlook for Connexa Sports Technologies is now a tale of two vastly different potential narratives, a dichotomy that creates a minefield for investors. On the one hand, there is the legacy sports technology business. The global sports tech market is growing, driven by an increasing emphasis on data analytics, athlete performance monitoring, and fan engagement. Connexa, with its established brands like Slinger and PlaySite, is positioned to capture a piece of this market. The opportunity lies in expanding its product distribution, growing its subscription base, and continuing to innovate in areas like AI-powered coaching and analytics. However, this is a competitive space, with numerous other companies, both large and small, vying for market share. The risk in this part of the business is that it becomes a slow, grinding battle for market share with relatively low margins, a scenario that is unlikely to generate the kind of explosive stock performance that many of its current shareholders seem to be expecting. On the other hand, there is the company's audacious venture into the world of cryptocurrency and AI matchmaking. The recent announcement of a $500 million joint venture with JuCoin Capital to launch a new cryptocurrency exchange focused on real-world asset trading is a massive leap into a completely different industry. This is the catalyst that has been driving the recent speculative frenzy. The potential reward here is enormous. If this venture is successful, it could dwarf the revenue generated by the entire sports technology division. However, the risks are equally monumental. The crypto market is notoriously volatile and subject to intense regulatory scrutiny. Furthermore, Connexa has no prior experience in this sector, making it a high-risk gamble on execution. The AI matchmaking venture is similarly speculative. While the online dating and social networking market is large, it is also fiercely competitive, dominated by established players. The success of this initiative will depend entirely on the efficacy of its technology and its ability to carve out a niche in a crowded marketplace. This is a classic expectation versus reality situation. The expectation, fueled by press releases and market hype, is that Connexa is on the verge of becoming a major player in two of the hottest tech sectors. The reality is that these are high-risk, unproven ventures that could just as easily end in failure. Comment below with your thoughts on this strategic pivot. Do you believe Connexa's move into crypto and AI matchmaking is a visionary masterstroke or a desperate gamble? In summary, Connexa Sports Technologies is a company at a critical crossroads, and its stock is one of the most speculative plays in the current market. The expectation is that of a plucky sports tech innovator on the cusp of a major breakthrough. The reality is far more complex and fraught with risk. The company's legacy business offers a modest but challenging path to growth, while its new ventures in crypto and AI matchmaking represent a high-stakes bet on emerging technologies. The recent stock performance reflects this tension, with wild swings driven by news and speculation rather than fundamental performance. Investors looking at Connexa through their Fidelity Brokerage or Robinhood app must understand that this is not a stock for the faint of heart. It is a binary bet on the company's ability to execute on a radical and unproven new strategy. The contrast between the simple narrative of a sports equipment company and the complex reality of a tech conglomerate in the making could not be starker. The path forward for Connexa is anything but certain, and anyone considering an investment must be prepared for extreme volatility and the very real possibility of significant loss. This is a story that will continue to unfold, and one that serves as a powerful reminder that in the world of investing, expectations and reality are often two very different things. The challenge for investors is to see beyond the hype and make a clear-eyed assessment of the risks and rewards that lie ahead.